Hello and welcome to another edition of 9 to 5 Live. I'm Mark Williams and joining me this morning is Francois Savary. What a week in the markets that was. I, for one, wasn't expecting that to happen. On the surface, we could have just stayed on the beach, but as indexes stayed exactly unchanged from the previous week, or more or less, in any case. However, that's just superficially. Underneath that, there was quite a lot happening. We need to understand what did happen and what does it tell us about the markets now. Francois, talk to us about last week.
What to say about last week? That it was a very difficult week if you were looking at the market minute by minute, because many things happened. But at the end of the day, we all know that you have two elements. You can discuss which one is the cause, which one is the consequence, but you had two developments. You had a lot of volatility on equity market, and you had the unwinding of carry trade on the yen, and it was quite significant. The main reason being monetary policy. Once again, we get back to this issue. This is the issue of liquidity, because there is a divergence between the Fed and the BOJ in terms of monetary policy. Japan is increasing interest rates. The US are going to lower interest rates. Why are they going to lower interest rates? Because suddenly you had fears that the economic activity in the US is slowing down quite significantly. This is the big question, and that's what made the market very unsettled last week, is the fear due to the non-farm payroll numbers that the economic activity in the US was slowing down quite significantly and that it could induce a recession. And that's the reason why suddenly people expected, and it was to my point of view completely crazy, that the Federal Reserve would act before the September meeting. And that was all these jitters that produced this volatility on the market.
Certainly last Monday and for the few days following that, market participants were starting to speculate that the Fed would reduce interest rates by 0.5% in September. Do you agree with that? Do you think that's an overstatement of the facts? And to what extent is the market now looking for any kind of indication of a slowdown in the economy?
I still defend, and we discussed that last week, I still think that it's too early to say, when you have one statistic, to say that the Fed is obliged, on the non-farm payrolls, that the Fed is obliged to cut interest rate by 50 basis points. And when you look at the different speeches of different members of the Fed, clearly they want to keep their option open when it comes to, will it be 25, will it be 50? Because now people assume that there will be a cut in September. So I would stick with my view that it will be 25 basis points. This week we will have a key number, which is the CPI number and the PPI numbers also. But those numbers are going to tell us a lot about the way the inflation is going on in the US. And I think that after those numbers, I could maybe change my view from 25 to 50, depending in if the trend on the inflation is still on the downside and the way the Fed wants it to be.
Apart from consumer price index and producer price index, it's a pretty important week this week for economic numbers. Talk to us about those and what we should expect and how it points us towards the future.
Again, in the global environment, when there are doubts about the economic activity in the US, Thursday is going to be very important, because you will have numbers coming from industrial production, retail sales. You will have some surveys coming from the Empire Manufacturing New York, from the Philly Fed Index, and a real estate index, which is the NAHB. And all those numbers which relate to economic activity, to my point of view, will be key, because this is a key factors for the market participant. Moreover, you will have a statistic that is going to stay quite important over the next few weeks, which is the jobless claims. Because we saw last week that jobless claims was a key factor in allowing the market to rebound. And it means that now, week by week, market participants are going to look at jobless numbers to see how the labor market is developing in the US.
Let's come to opportunities now, and what kind of opportunities the volatility in the market offers us. We discussed tech stocks that didn't really profit from the bounce at the end of last week. What is profiting? when should we be looking for opportunities in the market? And if it's not tech stocks, what should it be? Or maybe it is tech stocks.
I would say that for tech stocks, there is something that is quite important to have in mind. The valuation of the Magnificent Seven went from a 32 times PE forward to 26 times PE forward. This is quite a move. So I would say stick with your Magnificent Seven. The numbers they produced were not bad. They were numbers that brought some interrogation among the investment community about the fact that they were continuing to invest quite a lot and people were a bit disappointed by the fact that they were investing a lot. I would stick with that. I think that, again, you are in an environment where for the last 6 to 8 weeks, there was a lot of talk about the necessity for the market to broaden, the necessity for a kind of rotation in the market. I think we are in this environment. So I would look at opportunities outside of the Magnificent Seven, because usually people have quite an exposure to Magnificent Seven stocks. So I would try to find opportunities. Will I jump right now after 1 week and say, okay, last Monday was terrible, now we are back where we were? No, I think that we have in front of us a key development, which will be the September Federal Reserve meeting. Don't forget that in the mind of people, the issue of the Fed is too late once again is key, because it relates to the fact that economic activity is decelerating. So I would broaden and try to diversify my portfolio to face the next few months and not jump necessarily today into equity market. I think volatility will remain with us.
How are our good friends small caps and mid caps getting on?
They did not go well in the consolidation. I think for the future, what is key is we could experience last week that bond markets are back in a position to be a hedge against equity volatility. That's something that people need to have in mind. I still believe that the bond market is at a fair level at current level, and that it's not going to be a negative for the small and mid cap. Small and mid cap performance will depend on the ability of the US economy to experience a soft landing. What you want to see is signs that the soft landing is materializing in the coming months. So I think they have their place in a portfolio, but I would not put all my bets on small and mid cap because they have corrected lately.
In that case, you're suggesting that the week ahead is going to be a big pointer towards which sectors of the market can be most useful and most interesting.
Yes, and you need to go back to some trends. You need to consider and ask yourself, okay, we all know that the artificial intelligence is producing a lot of needs for energy and those kind of things. So we need to ask ourselves, okay, are utilities, which perform quite well this year, are utilities going to be again performing well in the future if the AI trend is continuing? You need to ask you a lot of questions about different stocks and look at them in a kind of medium term, with a medium term point of view to see if the soft landing scenario is going to produce the kind of return you expect for them.
Let's turn to Japan now. That was down 12% as we were talking last Monday, and next day was up 10%. It very largely finished unchanged as well, like most of the other indexes. The big carry trade unwind from the yen carry trade, the unwind from that, it didn't really happen, did it?
It did happen because when you look at numbers, and it's always difficult to have a definite answer when it comes to what was the kind of percent of the carry trade that was covered, but you have estimates between 50 and 75% of the carry trade on the yen that were turned by investors. So I think that the carry trade was unwinded. So the big question is now we need to see a stabilization of the yen, because otherwise the trend remains your friend. You want to see some kind of stabilization. That's the reason why the BOJ last week intervened in a way by saying, okay, we are not sure to increase rates immediately. So that was a way to cool down the market. What is key is that the yen needs to stabilize Because if we break the 140 level, you have some people who are talking about the fact that we could go much lower, because then it would reignite the remaining covering of the carry trade very, very quickly and leading to again volatility on the market.
Are there any indications of fair value for the dollar yen at the moment? Where would you expect the dollar yen to settle and start to find an equilibrium?
Remember, at the end of last week, I was talking about the fact that I was expecting at the time that the yen would go around 135 by the end of this year. And your remark at the time was, okay, but it is such a small movement. No, it was quite a significant movement, because currency movement can be very, very, very dangerous. What is the fair value of the yen dollar? Some people say that it's 100. So clearly the yen is undervalued. So that's the reason why there is a need for this reappreciation of the yen to be, in a way, moderate and step by step. Otherwise, you face the risk that it will continue to bring volatility to the market.
Just very quickly, can we touch on China, which has been a little bit disappointing in the past few months? What are your thoughts on China?
I would say that it was not a little disappointing. It has been very disappointing for investors who consider, when there were the news by the early spring that the government was intervening, that suddenly the people believed that the Chinese market was turning and going up. It went up and then it corrected again. I think that it's very difficult to have an assessment of the Chinese economy, but there is one statistic that is very interesting that I read this morning. Is the fact that during the second quarter of this year, you had outflow of 15 billion US dollar of direct investment into China. Foreigners are going out of China. And at this level, if we continue at this level, it could be the worst year for direct investment in China since the 1990s. And remember that in 2021, only, it was 300 billion US dollar of direct investment flowing into China. So it tells you, these statistics tell you a lot about the fact that international investors have a lot of worries about China. And so that's something that you need to keep in mind. I still believe, and we had the discussion in the spring, I told you, okay, I don't think that there is an opportunity to jump massively into China. I still stick with this idea for the time being, because you don't have clear indication that the situation, particularly economically, has turned around in China.
Thank you very much, Francois. I think that's all we've got time for this week. I look forward to speaking to you next Monday.
Okay, have a good week.
You too. Bye now.
Bye-bye.